I want to talk about this note from Morgan Stanley today. They say even if the second half of September warrants caution, it is going to be a Herculean task to interfere with strengthening AI visibility into 2026. Real money simply cannot afford to have a tracking error at this stage of the year. Wolf today, the Mag 7 continue to outpace the other 493. They continue to favor that. It feels like the market does too, although on obvious days like this, with rates coming down and rate cuts on the horizon, you would expect to see maybe the small caps up 1.3%, something like that. What do you think of these notes?
I think that we are, and listen, we hear it every year when the S&P has positive performance. You get through the other side of summer, chase for performance. You hear about a chase for performance. You hear about a lack of tax loss selling. And I think these are the catalysts that we're going to have in addition to continued strong earnings and rate cuts as you move through the fall. I think the bigger question as you move through the fall is how are you going to begin to prepare for 26? Because in 26, you kind of run out of a lot of these catalysts. It's also a midterm election year. I keep pointing this out. Markets don't like midterm election years. Markets in midterm election years like higher volatility and corrective behavior. So I think at some point, later in the fall, you have to begin to think about that. But for now, you could play into the narrative of the market continues to press higher and broaden out.
When you say you run out of catalysts, I mean, the whole point of some of these notes is that you don't run out of the AI catalyst. That's sort of the whole perspective. I was sitting on the stage out by the beach in Huntington Beach, and Rick Reeder was talking about that. That's why you're in what most people think are still given, even with the run in these stocks, even how their PEs have expanded, that you're still in the early innings.
So I think that the positive catalyst, the tailwind from the investment thesis surrounding artificial intelligence and the innovation advancing towards generative AI, I think that's a secular story. I don't think in 2026, if it's the only story, we will be able to defy a potential correction at some point. I think because there is maturity in terms of positioning for that thesis, maturity in terms of positioning. Everyone knows you want to be allocated towards AI. That's well known. And the cup is pretty full in that regard. So I think that, yes, you will see a pause that ultimately refreshes, but I don't think singularly that'll be enough to prevent a 26 correction.
Yeah. Josh, what do you make of this trading desk note from Morgan Stanley? Because we came into September saying, well, historically, it's a really bad month. And the market's trying to tell you, well, I know you didn't, but you know what I'm saying. I think that the broad thought was like, well, here we go, because the market's usually bad in the fall, September and October. And we all know what's happened in October's past throughout history. They say, again, just to reiterate, even if it does the second half of September warrant some caution, which maybe some people still suggest it does, it's going to be a Herculean task to interfere with strengthening AI visibility into 2026. In other words, stay with this trade.
I think so, and there are a lot of reasons to stay with it. And one of the key one for me, and we don't talk about it that often these days, but I'm taking a big cue from what's happening with international markets as confirmation of what's happening with the S&P 500 and the Russell 2000 here in the United States. Market after market after market. I don't care where you look. I don't care if it's Europe, Asia, Latin America, China. There's just something very big happening here that transcends whether or not we get 25 or 50 basis points of easing monetary policy here in the United States. And obviously, what all of these countries have in common is a consumer that is doing what the consumer is supposed to do and spend. You look at the data all over the world. But then the secondary thing is this AI infrastructure build-out, which is 100% a global phenomenon. Even the French are trying to be competitive in AI. So I think so long as those things are both moving in the right direction, international stock markets breaking out, and AI CapEx being a global phenomenon, I think you're probably in more danger trying to fade it, quite frankly, than staying put. What could go wrong? A policy mistake. Right now, there's an 89% chance of a 25 basis point cut and an 11% chance of a 50 basis point cut. So the market's pretty sure that we're going to get something. I feel pretty confident that we will. I would tell people, though, you might not like the rhetoric that comes along with the cut. Remember, we used to joke around, we used to have a hawkish cut. Like, I don't know, do you want Jerome Powell in a Q&A talking about maintaining restrictive stance or whatever, or being vigilant about the inflation picture? Like, I don't know how the market interprets that. They might not like the sound of it. So I would never tell people we're all clear. But look at what's working today. You know, ARC is up 3.3%. The consumer discretionary names are up the sector up 1.6% on the day. 30% of the tech sector has an RSI above 60. 13 stocks have an RSI above 70. Semiconductors are making record highs. So, like, there already is a lot of enthusiasm. So I think there's room to just say, look, I'm going to ride this. To answer your question, I'm going to stay with it. But I don't necessarily have to be out there hunting down my next 3 stocks that I want to buy. I think there's room to kind of keep both thoughts in your mind at the same time.
The SMH, to Josh's point, all-time high. Micron, 52-week high today. Joe, Lam Research, record high today. KLA, record high as well.
Those are the 2 semi-equipment names that I like the most. Applied Material really hasn't participated as much as Lam Research and KLA Corp have.